Inflation is a paramount problem. The ECB is holding an ad hoc meeting. It's very special times we're living in. So how is it affecting your investment process?
Yeah, it's impacting private equity investors on two dimensions. First, on the portfolio companies that they own at this moment. Of course, they're trying to price through the inflation to the customers, and at the same time, they do all the efforts to control the cost. It's also impacting how they look into new investments, because you want to invest in the sectors where you know you have pricing power, and you want to avoid those sectors where there can be an issue on pricing through the inflation. You might be better off in industries with critical components that are a low part of the cost chain versus consumer businesses where consumers can trade down away from your business.
Are you expecting that PE activity is slowing down now, given all these uncertainties?
Yeah, we see, private equity has always been a cyclical business. You know, if you look at it on a multi-decade basis, and we see the activity was still incredibly active in the first half of the year, still 500 billion of deals that have been done, but we see a slowdown now. Inflation, market volatility, also the scrutiny from the lenders, etc. We expect a slowdown of the activity in the second half of the year.
If you take a longer-term perspective, you were also telling me that it's probably not the worst timing to go into private equity. If you look back at the latest or the other period where we had high inflation, which was the end of the 80s or beginning of the 80s, right?
End of the 80s.
End of the 80s.
Yeah, so if you look on a multi-decade basis, private equity has always been a very resilient asset class. And the last time that there was real inflation was the end of the 80s and beginning of the 90s. And also in that period, actually private equity on average delivered double-digit returns. Slower than the peak moment, but still very positive. And what we see is the vintages that have been raised before a recession or before inflation typically do worse, but the vintages that have been raised during or after inflation and after the recession are typically the best performing vintages in the industry.
Let's look at Europe, because Europe clearly is a place which has special challenges with the war in the Ukraine and supply chain bottlenecks, high energy prices. So what's the major issue here when picking industries?
Yeah, so what we've seen in Europe is not that different actually as what we've seen in the rest of the world. So still a very strong first half of the year with a lot of activity, lower than last year, but still very active investments in Europe as well. And we've seen it across the industries, lots of interest still in technology, although those multiples will start to decline, and a lot of investments that are being done back into basic industries, but also healthcare, etc., continue to be very attractive sectors that people continue to invest in.
But it seems that exits are getting increasingly difficult. The IPO market seems to be rather deadish, looking at the market volatility. How long will that last?
Yeah, so the big change in the first half of the year versus last year was the exit route via IPOs has pretty much stopped. And that, of course, slows a lot of the money that's flowing back to the LPs. We expect this to continue, so the year for the exit will be significantly lower than what we've seen last year.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.